Hey everyone, welcome back to the channel. Today we're discussing a smart and easy way to invest your money, systematic investment plans or SIPs. Let's break down SIPs, how they work and why they might be the perfect addition to your investment strategy. So, what exactly is a systematic investment plan, or commonly known as SIP? SIP is a disciplined investment strategy where you invest a fixed amount of money regularly, usually monthly, into a mutual fund. Think of it like setting up a recurring deposit, but for investments in the stock market. Let's talk about how SIPs work. It includes 5 factors. First one, regular investments. With the SIP, you decide on a fixed amount to invest and the frequency, most commonly monthly. For example, you could invest 1,000 rupees every month. The second one is investing in mutual funds. The money you invest is used to buy units of a mutual fund. The value of these units depends on the fund's performance, which can vary from month to month. The third one is compounding returns. Over time, your investments benefit from compounding. This means that not only do you earn returns on your initial investment, but also on the returns that have already accumulated. Fourth one, averaging out costs. One of the advantages of SIP is rupee cost averaging. This means that you buy more units when prices are low and fewer units when prices are high, which can help reduce the average cost of your investment over time. The fifth one is flexibility. You can usually start an SIP with a relatively small amount and adjust the amount or frequency of your investments as needed. Some plans even allow you to pause or stop your SIP if necessary. So, why should you consider investing through an SIP? Well, here are some key benefits. The first benefit is discipline in investing. SIPs encourage regular investing, which helps build a disciplined approach to saving and investing. By setting aside a fixed amount regularly, you avoid the temptation to time the market. The second benefit is rupee cost averaging. As we mentioned earlier, SIPs help average out the cost of your investments. This reduces the impact of market volatility and can lead to potentially lower overall investment costs. The third benefit is compounding growth. Regular investments combined with compounding can significantly grow your wealth over time. Even small amounts invested consistently can add up to a substantial sum in the long run. The next one is professional management. When you invest through an SIP, your money is managed by professional fund managers who handle the research and decision making, so you don't have to worry about picking individual stocks or bonds. The last one, affordable entry. SIPs often have low minimum investment requirements, making them accessible to a wide range of investors. You don't need a large lump sum to start investing. Therefore, in conclusion, with benefits like disciplined investing, cost averaging, and professional management, SIPs can be a great addition to your financial strategy. So if you found this video helpful, be sure to hit that like button and subscribe for more content. Have any questions or experiences with SIPs? Drop them in the comments below. Thank you so much for watching, and I hope you have a great day ahead, and I'll see you in the next video.